Welcome to The Explainer. Today, we're dissecting the anatomy of a company that is quite literally engineered for rapid growth. We're talking all about Macpower CNC Machines Limited. Whether you're tracking industrial growth, keeping an eye on supply chain shifts, or you're just fascinated by the heavy machinery that builds our modern world, this company is an absolute masterclass in how to scale effectively. Okay, let's dive right in. Before we even glance at a single financial number, take a look at the physical reality of what they do. Sparks flying, heavy metal, pure precision. This right here is the beating heart of Macpower. They build the machines that build everything else. If you really want to understand this company, you've got to start with the steel. Today, we're mapping out Macpower's story across 5 key areas. We'll cover their foundation, their financial momentum, their massive order book, their strategic horizon, and wrap up with their business moat. Section 1, the foundation, building the machine. Let's take a quick look at their core DNA and the sheer scale of what they build today. Macpower is definitely not an overnight success story. They were established back in 2003, so they've spent well over 2 decades really mastering their craft. A huge inflection point for them was their 2018 IPO. They brilliantly used those proceeds to backward integrate, which basically means they started manufacturing their own core components, in-house instead of buying them. That move massively enhanced their capacity and set the perfect stage for their 2026 market leadership goals. And this beauty right here is the Macpower DCM3222. It's a cutting-edge, high-end, computerized, numerically controlled, or CNC machine. When we're talking about CNC machines, we mean highly complex, fully automated tools that can carve, turn, and mill metal with microscopic precision. We are talking about seriously high-value engineering. Now, here is what's truly staggering about the company. They don't just make one type of machine. They offer a massive arsenal. They produce turning centers, vertical machining centers, horizontal machining centers. The list just goes on. All in, they have over 383 variants and models. Because of this incredibly vast portfolio, they serve more than 27 different product segments and have successfully completed over 13,875 installations. They are deeply, deeply embedded in the industrial fabric. Moving on to Section 2. Financial momentum, record-breaking output. So, how does all that heavy physical machinery translate into actual business performance? Let's take a look. The sheer velocity of their growth right now is just incredible. Looking at Q1 for fiscal year 2027 compared to the exact same time last year, their revenue jumped from 610.3 million rupees to 952.4 million rupees. That is a 56.1% increase. But honestly, even more impressive, their EBITDA, which is their core operational profitability, skyrocketed from 79.2 million to 154.3 million. That's a staggering 94.8% growth year over year. So they aren't just selling more machines, they are operating so much more profitably. And the absolute crucial metric here is 16.20%. That is their EBITDA margin for Q1 of 322 basis points, or 3.22% from the previous year. You might be wondering, how did they pull that off? Well, a major driver is their strategic pivot toward higher-end premium machines. By selling more sophisticated equipment, they capture significantly higher margins, which fundamentally upgrades the profitability profile of the entire company. Which brings us to Section 3, a massive order book, the pipeline. Obviously, a company is only as strong as its future orders, so let's see how this current momentum builds into future demand. Macpower's future is looking incredibly robust right now. As of June 30th, 2026, their pending order book stood at a massive 4,559 million rupees. And here's the kicker. Their premium Nexa line makes up 40% of the value of this pending order book. This is hard proof that their strategy to push higher-end, higher-margin machines is actively working. The market is absolutely validating their approach. But hey, they aren't stopping there. Beyond the orders they already have in hand, they're aggressively out there bidding for new work, with over 10.4 billion rupees in total bids submitted. That includes about 7.3 billion in domestic bids and another 3 billion in tender bids that are currently under evaluation. They're heavily targeting institutional and defense tenders, which, as we're about to see, is a brilliantly strategic move. Let's look at Section 4, Strategic Horizon, the 2026-2030 blueprint. With demand exploding like this, they desperately need more capacity. To actually meet all this demand, Macpower went ahead and secured a massive 30-acre site for a state-of-the-art greenfield plant. Phase 1 involves a 100 crore rupee capital expenditure to build capacity for 2,000 machines. By year 1, their total company capacity will hit 5,000 machines. But their ultimate 5-year goal? A staggering total capacity of 10,000 machines. Unlocking this kind of scale gives them massive operating leverage, with real potential to push those EBITDA margins past 18%. Now, it's not just about building more machines. It's about building highly strategic machines. They're dedicating an incredible 50% of this new plant specifically for defense and aerospace work. These are high-margin, long-cycle contracts that create immense revenue visibility. On top of that, they're pushing into advanced controls and robotics, targeting global joint ventures for export, and, get this, powering 90% of their daytime operations with captive solar power. That drops energy costs and gives a nice boost to their ESG profile. Section 5. The business moat. Competitive edge. Let's look at the underlying advantages that make Macpower so resilient against their competitors. Let's start with their balance sheet. Look, heavy industry is notoriously capital-intensive, right? And so many of their competitors are just heavily burdened by debt. Not Macpower. They operate with literally zero debt and maintain a net cash surplus. On top of that, there's an incredibly high promoter holding of 73.22%. That tells us the founders and operators have serious skin in the game. They're intensely aligned with the long-term success of the company, ensuring strict financial discipline and responsible growth. Operationally, their moat is just as deep. By manufacturing their critical components in-house, they severely reduce their reliance on imports, which basically shields their margins from global supply chain shocks. Plus, achieving those technical pre-qualifications for defense contracts is incredibly difficult. It creates a massive barrier to entry that keeps competitors locked out. And because of their hyper-efficient operations, their asset turnover ratio currently sits around 3x, with the potential to scale up to an industry-leading 5x in their current plant, meaning they generate massive revenue incredibly efficiently from the physical assets they already have. I'll leave you with this final provocative thought. As global supply chains continue to shift and localize, Macpower is positioning itself to be much more than just a profitable business. Think about it. With zero debt, a massive 10,000 machine expansion underway, and a deep pivot into defense and aerospace, they are effectively building a critical piece of national infrastructure. The question really isn't just how big Macpower will get, but how their explosive growth will reshape the entire landscape of indigenous manufacturing. Thanks for joining me for this explainer, and definitely keep your eye on this space.
Enjoyed the video? Please like, comment, and share. And don't forget to subscribe to our channel and hit the bell icon for more stock market updates and